A memory chip company just posted a higher gross margin than Nvidia. 79%. Not a software company, not a platform monopoly, a company that makes memory chips. An industry famous for price wars and margin collapses. SK Hynix just listed on the Nasdaq under ticker SKHY, raising over $26 billion in the third largest IPO in history. How did a memory company become more profitable per dollar than the most valuable chip maker on Earth? By stopping making the memory chips that go into your phone and your laptop and going all in on AI. But that decision created a side effect no one on Wall Street seems to be pricing in. The same week SK Hynix listed in New York, China's largest DRAM manufacturer launched its own IPO in Shanghai, selling exactly the chips SK Hynix walked away from. Last quarter, that company's revenue was up 719%. Let's start with what SK Hynix actually is, because it's not just a memory company. First quarter 2026 revenue, $34.9 billion. Year-over-year growth, 198%. Gross margin, 79%. For context, Nvidia's gross margin last quarter was 73%. A memory company, an industry historically known for razor-thin margins and brutal price cycles, is now more profitable per dollar of revenue than Nvidia. The reason is three letters: HBM, high bandwidth memory. Here's what HBM actually is. Every DRAM chip starts from the same basic building block, a memory cell etched onto silicon. Conventional dirt takes that building block and lays it flat on a circuit board, which takes the same building as a block on stacks 8 to 16 layers of it vertically, wires them together with thousands of copper pillars drilled straight through the silicon, and places the entire stack right next to the GPU. Same raw material, radically different engineering, and radically different pricing. SK Hynix makes more HBM than anyone else on Earth. 56.4% global market share as of the first quarter, according to IDC. Its F1 filing with the SEC shows that 42% of its memory revenue now comes from HBM. UBS estimates the company is locked in roughly 70% of Nvidia's HBM4 orders for the next-generation Rubin platform. Nearly all of the IPO proceeds are going straight back into expanding production capacity. This isn't a company raising cash because it needs to survive. It's raising cash because demand is so far ahead of supply that every dollar of new capacity pays for itself. And by listing on the Nasdaq, it gets something it's never had: direct access to the deepest pool of institutional capital in the world at a forward multiple that's still below Micron. So far, this sounds like a straightforward story. The world's leading HBM maker goes public in the US at a discount to peers. Easy call. But there's a structural side effect of SK Hynix's success that almost no one is pricing in. To make HBM, you need wafer capacity, a lot of it. Because you're stacking 8 to 16 DRAM dies into a single package, each HBM chip consumes roughly 3 times as much silicon as a standard DDR5 module, and it generates 3 to 5 times the profit. So SK Hynix, along with Samsung and Micron, made a rational decision: redirect advanced production lines away from conventional DRAM and toward HBM. No board of directors would choose differently. But here's what that decision does to the rest of the market. AI data centers don't just need HBM. Every server still requires conventional DDR5 for system memory. Phones, laptops, cars, none of them use HBM. Both types of memory are essential. But when the three companies that control over 90% of global DRAM production all shift their best capacity toward HBM at the same time, the supply of everything else physically shrinks. Not because demand fell, demand grew. But the factories that used to make those chips are now stacking dies for AI. Prices for conventional DRAM have risen roughly 700% over 4 years. It got so extreme that consumers filed an antitrust class action lawsuit against all three companies in June, alleging coordinated supply restriction. And this is exactly where CXMT enters the picture. China's largest DRAM manufacturer puts 99% of its output into conventional DDR and LPDDR, the products the big three walked away from. First quarter revenue, $7.5 billion, up 719% year over year. Its IPO in Shanghai next week is set to be the largest A-share listing of the year. Apple's CEO personally went to the U.S. Treasury Department to ask whether Apple could buy CXMT's chips made by a company on the Pentagon's military-linked entity list, because conventional memory has become that scarce. Here's what this means for anyone evaluating SKHY. The entire thesis, the 79% gross margin, the trillion-dollar-plus market cap, the Nvidia partnership, rests on one assumption. AI demand keeps accelerating, and HBM remains the bottleneck. As long as that holds, SK Hynix never needs to go back to making commodity DRAM. Its margins stay sky high, and the gap it left behind keeps getting filled by players like CXMT. But memory has been through this before. The memory industry has a long history of supercycles that felt permanent until they weren't. SK Hynix's own F1 filing lists cyclicality as a core risk factor. So let's think through what the two scenarios actually look like. In the first scenario, AI capital spending keeps accelerating. Hyperscalers keep building data centers. HBM demand stays ahead of supply through 2027 and beyond. SK Hynix's capacity expansion in Yonggi comes online and gets absorbed immediately. In this world, SK Hynix's margins hold, its valuation re-rates upward, and it becomes the TSMC of memory. Meanwhile, CXMT keeps growing in the conventional DRAM market that the big three have permanently vacated. The supply chain fractures into two separate ecosystems: a US-Korea HBM corridor for AI and a China-centric commodity DRAM network for everything else. Both sides make money. Neither side competes with the other. In the second scenario, AI spending slows. Hyperscalers pull back. All that HBM capacity starts looking for a home, and some of it gets redirected back to conventional DRAM. When it does, CXMT faces a cost structure that a supercycle was hiding. A 16-nanometer process versus the big three's 10-nanometer class. Dies 40% larger. Unit cost more than 30% higher. But here's the complication. CXMT's customers, Tencent, which just signed a 20 billion yuan long-term supply deal, Huawei, Lenovo, Xiaomi, have already rebuilt their supply chains around domestic memory. Once a customer completes qualification, integration, and inventory planning with a new supplier, they don't switch back just because Korean prices come down. The fracture may already be permanent. Two forces pulling in opposite directions. One where SK Hynix's moat gets deeper every quarter. Another where the market it abandoned learns to live without it. SK Hynix and CXMT are both going public in the same week. One raised $26 billion on the Nasdaq. The other is raising $4.3 billion on the Shanghai Star Market. Both are reporting record profits. Both are betting that now is the best possible window to sell shares to the public. SK Hynix is betting on a future where AI demand never slows down and technology leadership is the only thing that matters. CXMT is betting on a future where China needs its own memory supply chain regardless of the cycle. The investors buying both stocks are making fundamentally different bets about how the world works. When every player in an industry simultaneously believes it's the perfect time to go public, memory's history suggests that's exactly the moment worth thinking about most carefully.